Okay, so let's do a quick reality check here. It is February 23rd, 2026. And if you pull up a trading app right now, it looks like the world is just absolutely on fire. In a good way, I mean. The S&P is flirting with 8,000. The NASDAQ is smashing through 30,000. It really feels like this whole AI boom is the party that is never, ever going to end.
Oh, yeah. Certainly feels like the roaring 20s on steroids right now. I mean, corporate profits are breaking records every single quarter. Productivity is through the roof. And the general vibe out there is that we've somehow unlocked a cheat code for the economy.
Which is exactly why the document you dropped in our shared drive yesterday felt like a bucket of ice water. It's a macro memo released just yesterday by Citrini Research, and it's titled The 2028 Global Intelligence Crisis. And honestly, reading it felt like watching the first 10 minutes of a horror movie where everyone is having a great time at the lake house, but you just know the killer is already in the basement.
It is definitely a sobering read. But before we spiral into doom and gloom here, we need to be very clear about what this actually is. This isn't a prediction. The authors, Citrini and Alabshah, they frame this specifically as a thought exercise or scenario planning. They're asking a very specific, very uncomfortable question for this deep dive. What if the AI bulls are 100% right about how good the technology gets, but that actually turns out to be catastrophic for the economy?
And that's the hook that really got me. Because we have this baked in assumption, almost like a religious belief at this point, that if the tech is good, the economy is good, better tools equal more wealth, right? But this memo argues the exact opposite. It argues that by 2028, we could be looking at a total economic unraveling precisely because the tech succeeded. Because intelligence, which used to be the absolute scarcest, most expensive thing on Earth, suddenly becomes abundant and cheap.
Exactly. When you take a historically scarce resource and just make it abundant, you get a violent repricing of the entire world. And that is what we're going to map out today. The memo lays out a timeline, really a roadmap to the cliff edge. It starts with what they call ghost GDP here in 2026, then it moves to the death of the intermediation economy in 2027, and ends with a complete financial plumbing crisis in 2028.
So let's start where we are right now, in 2026. The memo describes our current moment as ghost GDP. It sounds spooky, but I want to understand the mechanics of it. How can GDP be a ghost? If the numbers are up, they're up, right?
Well, think about how we actually measure GDP. It's basically the total value of goods and services produced. In this scenario, productivity is skyrocketing because we have AI agents, digital workers that don't sleep, they don't get sick, they don't need health insurance. They are churning out code, marketing copy, legal analysis. The output is just massive.
So on paper, the economy looks huge because we're just making more stuff.
Right. But a healthy economy isn't just production. It's consumption.
Mm.
It relies on the velocity of money, which is how many times a dollar changes hands. And that is where the ghost part comes in. A GPU cluster running in a data center in North Dakota might do the work of 10,000 junior analysts in Manhattan. It produces the work, but it doesn't participate in the economy.
Oh, I see. Because the GPU isn't buying a salad at Sweetgreen for 18 bucks. It isn't taking an Uber to a happy hour or saving up for a condo in Brooklyn.
Precisely. You are replacing high-velocity consumers, human beings, with zero-velocity producers, the machines. This triggers what the memo calls the Human Intelligence Displacement Spiral. Companies fire workers to save money, margins go up, stocks rally. So what do the companies do with those profits?
They reinvest it. I mean, in the past, they might have hired more people to expand into new markets, but now...
Now they buy more AI,
Yeah.
which allows them to fire even more workers to further increase margins. It's a negative feedback loop for labor, but a massive positive feedback loop for corporate efficiency.
I do want to push back on this for a second, though. We've heard this whole robots will take our jobs narrative for 200 years. The loom, the assembly line, the spreadsheet, every time we just found new, better jobs. Why is this time different? Why doesn't the displaced analyst just become a prompt engineer or an AI supervisor?
That is the trillion-dollar question. And the memo argues this is fundamentally different because of the speed and the nature of the capability. We aren't replacing muscle this time, we are replacing cognition. And we're doing it instantly. The memo actually points to a specific event, a canary in the coal mine, that signals this shift is real. They call it the ServiceNow moment, happening in Q3 of this year, 2026.
Okay, ServiceNow. Huge enterprise software company. They make the platform that IT departments use to manage tickets and workflows. Not exactly a household name for everyone, but massive in the corporate world. What happens to them?
In this timeline, ServiceNow announces a massive efficiency program. They lay off staff to boost margins using AI. That's the standard playbook for 2026. But then their stock tanks. Why? Because their revenue growth decelerates. And it slows down because their clients, the Fortune 500 companies, are also firing people.
Ah, I see where this is going. ServiceNow sells seats, right? They sell licenses per human user.
Exactly. If your business model depends on selling software to humans, and your customers are aggressively replacing humans with AI, your addressable market shrinks. It's a total paradox. Companies are using AI to cut the very jobs that buy the software. It becomes a knife fight where incumbents have to cut costs just to survive, which only accelerates the downward spiral.
It's literally the snake eating its own tail. And it's not just buying fewer seats. The memo talks about something called the agentic shift. This felt like the moment the software industry effectively destroys its own pricing power.
It really is. By late 2025 and early 2026, we saw this massive leap in agentic coding. This isn't just asking a chatbot to write a snippet of Python. This is an AI agent that can architect and build entire applications. So imagine you are a CIO at a big company. You have a $500,000 renewal coming up for some SaaS tool, maybe a CRM or project management tool. Suddenly you realize, wait, my internal AI agents can build a clone of this software in 3 weeks for $5,000 in compute costs.
So you just don't renew, or you go to the vendor and say, look, I'm not paying 500 grand, I'll pay 50 grand, or just build it myself.
And that destroys pricing power across the entire sector. If I can replicate your core product for the cost of electricity and compute, you don't have a moat anymore. The deflationary pressure is immense. And this leads us directly into early 2027.
Right, so 2026 is the year the cracks form in the B2B world, but the memo says early 2027 is when friction goes to zero. This is where the consumer, you and me, really starts to feel it. And honestly, at first glance, this part sounds awesome. Who actually likes friction?
It does sound incredibly convenient. This is the phase where AI moves from being a chatbot you have to actively talk to an agent running silently in the background of your life 24/7. It handles your shopping, your booking, your bills. But the massive casualty here is the intermediation economy.
The middleman.
The middleman, yes, but specifically the business models built on human laziness. Think about why you use DoorDash or Uber Eats. Be honest.
Because it's on my home screen, it has my credit card saved, I'm hungry, I press the button. I don't check 3 other apps to see if the delivery fee is $2 cheaper somewhere else. I just pay the lazy tax.
Right, your laziness or your habit is their moat. That is what investors are valuing. But an AI agent doesn't have habits. It doesn't have a home screen. If you tell your agent to get you a burger, it instantly pings DoorDash, Uber Eats, and 20 other local delivery networks. It compares price, delivery time, and reliability in milliseconds and executes the trade on the absolute cheapest platform.
So brand loyalty is just dead. The app stickiness that venture capitalists love is completely dead.
For machines, yes. And that destroys the unit economics of these gig economy platforms, because they can no longer rely on you just defaulting to them. They have to compete on pure price for every single transaction.
The example that really blew my mind in this section was real estate, the buy-side commission. This feels like something that has been ripe for disruption for decades, but AI is what actually breaks it.
Oh, the realtors are in serious trouble in this scenario. The memo project's buy-side commissions collapsing from that standard 2.5% or 3% down to under 1%.
Because what does a buyer's agent actually do? They find listings, they know the comparables, they handle the transaction paperwork.
They sell information asymmetry. They say, I know something you don't. But an AI agent has perfect knowledge of the MLS, transaction history, zoning laws, crime stats, and comparable sales. It can negotiate objectively without emotion. The core value prop of the human agent just vanishes.
And it's the exact same dynamic for insurance and subscriptions, right? I felt very seen by this part. I passively renew my car insurance every year because shopping around is a massive pain in the neck. I know I could save money, but I just don't do it.
And that pain is worth billions to the insurance industry. They count on the apathetic renewal. In this scenario, your agent ruthlessly negotiates every single renewal, every single year. That passive renewal revenue stream that insurers rely on just evaporates.
Wow. Okay, but this next part is where the dominoes really start falling in the financial system. The payment plumbing. I always thought Visa and Mastercard were untouchable. They're the toll roads of the economy. Every time money moves, they take a cut. How on earth do you disrupt that?
You bypass the toll booth. Think about it. Why do merchants pay that 2 to 3% interchange fee to Visa? Because swiping a card is convenient for the human customer. It's fast, it works, we trust it. But if a machine is making the purchase for you in the background, it doesn't need a plastic card. It doesn't need a point-of-sale terminal.
So the agents start using, what, crypto?
Exactly. The memo explicitly mentions stablecoins on high-speed chains like Solana or Ethereum Layer 2s, near instant settlement, and for a fraction of a penny in fees. If you are an AI agent buying something from another AI agent, why on earth would you pay Visa 3%? You wouldn't.
That is a terrifying thought for the banks, and the memo singles out American Express as the biggest loser here. Why them specifically?
Two reasons. First, Amex relies heavily on those merchant fees, which the agents are bypassing. But second, look at their customer base. It's high-spending, status-conscious, white-collar workers. In this scenario, those are exactly the people who are about to walk off an economic cliff.
Which brings us to the white-collar recession of mid to late 2027. This is really the emotional core of the crisis. We're used to recessions hitting the factory floor or the construction site first, but this is the exact inverse.
It is the Patagonia vest recession. This crisis hits the memo writers, the middle managers, the knowledge workers. The memo uses a pretty brutal example, a Salesforce product manager making $180,000 a year.
I know 3 of those people personally. They're smart, they work incredibly hard.
Right. But in this scenario, she loses her job. She spends 6 months looking, but there are no product management jobs because AI is doing the roadmap and the spec writing. Eventually, she has to make ends meet, so she starts driving for Uber.
And she's making, what, $45,000?
Maybe. And think about the downstream effects of that. First, she floods the gig economy, which drives down wages for the people who are already driving for Uber. But the bigger macro issue is the spending cliff.
Because that product manager was the engine of the consumer economy.
Correct. The top 20% of earners drive about 65% of discretionary spending in the U.S. They're the ones buying new cars, going to Disney World, renovating kitchens. When that group stops spending, the broader economy hits a brick wall.
But here's the tricky part, the lag. The memo says the data actually looks fine for a while. Why doesn't the alarm bell ring immediately in early 2027?
Because high earners have buffers. If you're making $180K, you have savings. You have a 401k, you keep up appearances for a few months, you don't sell the house immediately, you do put the groceries on the credit card. So the macroeconomic data looks okay until the savings run out, and then it falls off a cliff all at once. The memo projects initial jobless claims surging to 487,000 in Q3 2027, and it's mostly white-collar workers.
And that leads us to the part of the memo that genuinely scared me, the financial contagion. It's titled The Daisy Chain of Correlated Bets. This felt pretty complex, so I really want to unpack it for the listener.
This is where we move from a sad recession to a systemic collapse. The central thesis here is that our entire financial system, specifically the private markets and shadow banking, is a leveraged bet on white-collar productivity.
Can we break that down? Because shadow banking always sounds nefarious, but it's really just non-bank lending, right?
It's actually quite simple. Over the last decade, traditional banks stopped lending to risky tech companies, so private credit stepped in. These are massive, unregulated funds that lend money to companies.
Okay, so private credit lends to tech.
Right. Private equity firms bought up thousands of software companies. They bought them using massive loans from these private credit funds. And the assumption, the core collateral for the loan, was annual recurring revenue, or ARR. They assumed that businesses would just keep paying for that software forever.
But we just established in the ServiceNow moment that AI kills the software pricing and the human seats.
Exactly. The memo calls this the Zendesk moment, scheduled for September 2027. In the scenario, Zendesk defaults on the largest private credit loan in history. Why? Because AI agents replace the need for customer support seats. Zendesk's revenue isn't recurring anymore. It's gone.
Okay, so a software company goes bust. A private equity firm loses money. Why do you, the listener, care? You're probably not a PE partner. If they make bad bets, they lose money. That's just capitalism.
You care because of who actually gave them the money. This is the permanent capital myth. Private equity firms didn't just use their own cash. They went out and bought life insurance companies. They took the annuity checks from grandma, the retirement savings of Main Street, and they lent it to these software companies to chase higher yields.
Wait, stop. So my grandmother's annuity, which is supposed to be the absolute safest thing in the world, is effectively holding the debt of a software company that is about to be automated out of existence.
That is the systemic risk. It's a daisy chain. Software revenue collapses, which means the software company defaults, which means the private credit fund takes a massive loss, which means the insurance company's balance sheet cracks. Regulators have to step in. Credit freezes entirely. Suddenly, you can't get a car loan. You can't get a mortgage because the institutions that hold the capital are insolvent. It's 2008 all over again, but instead of bad mortgages, It's bad software loans.
And speaking of mortgages, we can't ignore housing. The memo predicts a mortgage crisis in 2028. But again, it's weird. These aren't subprime borrowers. These aren't people buying 5 houses with no verified income.
No, these are prime borrowers. 780 FICO scores. Tech workers in San Francisco, Seattle, Austin. They were perfectly good borrowers when they took out the loan, but they borrowed against a future income that simply no longer exists.
So you have a wave of defaults in the most expensive housing markets in the entire country.
Delinquencies completely spike in tech hubs.
Yeah.
You have people with million-dollar mortgages who are suddenly competing for gig work. And this leads to the ultimate crisis, the government's dilemma.
The tax base. I honestly didn't even think about this until I read the memo. If people aren't working or they're working for a quarter of their old salary, they aren't paying income tax.
And our tax system is built almost entirely on taxing human labor. Income tax, payroll tax. In the scenario, the labor share of GDP crashes from 56% down to 46%.
Yeah.
Tax receipts absolutely plummet just as the government needs to spend drastically more on unemployment benefits for displaced workers and bailouts for the insurers.
It's a total pincer movement, less money coming in, massive demand for money going out, and the social fabric just starts to tear. The memo describes Occupy Silicon Valley protests blocking OpenAI and Anthropic offices.
The wealth gap explodes. Because remember, productivity is still high. The economy is producing a lot of stuff. But the gains aren't going to the workers. They're going to the people who own the compute, the hardware, the data centers, the models. It becomes a fundamental conflict between labor and compute.
And the policy response seems chaotic. The memo mentions proposals to tax compute, proposals for a sovereign wealth fund.
The Transition Economy Act versus the Shared AI Prosperity Act. The memo portrays Washington as completely gridlocked. They're trying to use 20th century tools like payroll tax adjustments to fix a 21st century problem. They simply don't know how to tax a robot that lives in a server farm.
So we arrive at the end of the timeline, June 2028. The S&P is down massively. The economy is in a depression. It is an incredibly bleak picture. But the memo ends with this concept of the intelligence premium unwind. I want to spend a minute on this because I really think it's the philosophical key to the whole thing.
It is the core insight of the entire document. For all of human history, intelligence was scarce. It was highly valuable. If you were smart, fast, and could process information better than others, you commanded a premium. You got the good job, you got the big house.
The doctor, the lawyer, the engineer, that was the established path to wealth.
Right, the entire economy, the mortgages, the corporate debt, the tax structures, university tuition, all of it was priced for a world where that human intelligence remains scarce and expensive.
And now it is abundant. It's cheap. It's just a commodity.
And the painful part isn't the technology itself. Abundance is objectively good. The pain comes from the repricing of everything that was based on that scarcity. When the cost of intelligence goes to zero, the value of the intelligence premium goes to zero. And that wipes out trillions of dollars of perceived wealth.
Okay, I feel like we all need to take a deep breath here because we are back in 2026. The sun is still shining. This hasn't actually happened yet. The memo explicitly says the canary is still alive.
Right. This is a scenario. It is a stress test. It is meant to help us prepare, not to scare us into total paralysis. We are still seeing the early stages. The market is still euphoric today.
But it completely forces you to look at the daily headlines differently. When you see a company announce efficiency gains with AI, you don't just think, oh, bullish for the stock. You think, okay, who is losing that income and what happens to the economy when they stop spending?
Exactly. It forces you to connect the dots between a cool tech demo and the actual stability of the global financial system. It reminds us that an economy is an ecosystem. You can't just remove the apex predator, or in this case, the apex consumer, the white-collar human worker, without collapsing the entire food chain.
So I want to leave you, the listener, with the provocative thought that the memo ends with. It's a question that really stuck with me, and I think everyone listening needs to ask themselves this in the mirror tonight.
It is the ultimate question of personal obsolescence.
If your income is based on being smarter or faster than the average person at processing information, writing emails, analyzing data, coding apps, and a machine can now do that for $200 a month, is your personal business model already obsolete and you just haven't realized it yet? Maybe we all need to start looking at skills that require operating in the physical world, things a server farm can't touch.
It is a heavy question we all need to sit with, and maybe start thinking about what a pivot looks like before the crisis actually hits.
On that cheery note, Thank you for walking us through this deep dive. It's a heavy one, but I would much rather think about it now than be totally surprised in 2028.
Always a pleasure. Let's just hope the canary keeps singing a little bit longer.
We'll catch you on the next deep dive. Stay curious.